So you're looking at a stock, right? And the big question hits you. The one every single investor has to face. Is this thing actually a good deal? It sounds simple, but wow, getting it right is the hard part. Let's break down one of the most common tools investors use to start figuring that out. That's the $1 million question, isn't it? You see a price, but what does that number really mean? Is it a hidden gem that nobody's noticed yet? Or is it an overhyped dud that's about to tank? Well, to get a first clue, most people turn to a simple little metric called the PE ratio. All right, so what is this thing? You see it everywhere, right next to a stock ticker. It's called the PE ratio. And at its heart, it's a really simple but really powerful way to get a quick feel for a stock's value. Okay, so the price to earnings ratio, the name pretty much gives the game away. It literally compares the price of one share of a stock to the company's earnings per share. And that's the key. It's not just about how much a stock costs, it's about how much it costs relative to how much money the company is actually making. It's a quick snapshot of market sentiment. And you know what the best part is? The math couldn't be easier. Seriously, no crazy formulas here. You just take the current stock price, you find what the company earns per share, that's the EPS, and you just divide the price by the earnings. That's it. Let's make it super concrete. Say a stock is trading at 45 bucks a share, and over the past year, the company made $3 in profit for every share out there. You take that $45 price, divide it by the $3 in earnings, and boom, you get a PE ratio of 15. Easy, right? But what does that number, 15, actually mean? This is the best way to think about it. A PE of 15 means that investors, the market, are willing to pay $15 right now for every $1 that the company is currently earning. It's like the price tag on profitability. Put another way, if that company's profits never changed, it would take 15 years for its earnings to add up to the price you paid for your share. Okay, now we're getting to the interesting part. Because you'll see PE ratios that are tiny, like 5, and some that are massive, like 200. So, is a high PE good? Is a low one better? Well, like with pretty much everything in investing, the real answer is it depends. Let's look at what the signals might mean. And this shows you why it's tricky. A high PE can be a sign of incredible optimism. Investors are so excited about future growth that they're willing to pay a huge premium today. We usually call these growth stocks. But it could also just be a red flag that a stock is way overvalued. On the flip side, a low PE could be a sign of a fantastic bargain, a so-called value stock that the market is ignoring. Or it could mean the market thinks the company is in trouble and its earnings are about to shrink. Neither number is automatically good or bad. And that right there brings us to the single most important rule about the PE ratio. A PE of 20 or 10 or 50 by itself is almost completely useless. It's like hearing a single note without the rest of the song. A PE number only becomes meaningful when you have something to compare it to. Context is everything. So how do you give it that context? Well, there are 3 golden rules. First, you have to compare apples to apples. Look at a company's PE next to its direct competitors in the same industry. Second, compare the company to itself. Is its PE today higher or lower than its own average over the last few years? And third, see how it stacks up against the whole market, like the S&P 500 average. This chart makes the point perfectly. Take a look at company A. It has a PE of 35. Now, if you just compare that to the industry average of 25, you might think, whoa, that's expensive. But then you look at its biggest competitor, competitor B, which has a PE of 40, suddenly company A doesn't look so pricey after all. It actually looks a bit cheaper. See, context changes the entire story. Now, you might hear people throw around the number 15 as a sort of historical average for what's fair value. And yeah, for a big, stable, established company, that can be a decent starting point. But, and this is a big but, it's just a general guideline. A fast-growing tech company is going to have a way higher PE than a slow and steady utility company. Okay, so we get what it is and we know we need context. But to really use this tool well, you have to know its limits. You have to know what the PE ratio doesn't tell you. And trust me, it has some pretty big blind spots. First thing to know is that not all PEs are created equal. You've got your trailing PE, which uses real, actual earnings from the past year. That's solid fact, but it's like driving by only looking in the rearview mirror. Then you have the forward PE, which uses guesses about future earnings. That's more relevant, but it's a forecast, and forecasts can be wrong. You gotta know which one you're looking at. And here are some other big ones. If a company is losing money, well, its earnings are negative, and poof, the PE ratio is completely useless. You'll just see N/A. The PE also tells you zip about how much debt a company has. And maybe the biggest blind spot of all, the standard PE completely ignores how fast a company is growing. So to fix that big growth problem, investors came up with a really clever upgrade, the PEG ratio. That's price to earnings to growth. It takes the PE one step further by actually factoring in the company's expected growth. The math is simple. You just divide the PE ratio by the earnings growth rate. And the cool thing is, this gives us another awesome rule of thumb. Generally, a PEG ratio below 1 is seen as a potential sign that a stock is undervalued. Why? Because its price, as measured by the PE, is low compared to how fast its earnings are expected to grow. It helps you justify a high PE. So, after all of that, what's the big takeaway here? It's that the PE ratio is an amazing tool, but it's a compass, not a treasure map. It'll point you in a direction, but it won't tell you exactly where the gold is buried. This right here, this sums it all up. The PE is your starting line. Think of it as a great screening tool. It lets you take the whole universe of thousands of stocks and quickly narrow down your list to find interesting ideas. But it should never be the only reason you buy or sell something. The real deep understanding of a company comes from looking at the whole puzzle. The PE is just one important piece. You've got to put it together with other clues, like the company's debt, its profit margins, and the overall strength of its business. So you get it now. The PE ratio isn't a magic number that gives you all the answers. It's a powerful lens, it helps you compare, it helps you ask smarter questions, and it helps you start to really understand a company's value. You've got the tool now, so the only question left is, how are you going to use it to investigate your next great idea?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.